This is The Change Physician, episode 227.
Hey, folks, welcome back to The Change Physician. This is your host, Dr. Kevin Cuccaro, with my Amazeballs co-host, Dr. Melissa Katie, and our returning guests, the fantastic Dr. Eric Tait. Eric, how are you doing?
I am great. Thank you all for having me back on a beautiful Saturday morning.
All right. Yeah, we are doing this a little early for me, which is why it's kind of dark for me here. All you central time people.
Yes.
Central
Texas people.
It's still coffee time for me. But we wanted to get Dr. Tait back on the show here because Eric has probably one of the best financial minds that I've ever had the privilege to actually discuss with. And the economy is everywhere. The news is blaring things. Most of it is fluff. If you haven't noticed, it's really hard to get the facts here. And the first thing I thought of was, let's talk to Eric, because Eric has a good head and he can give us both what we're seeing right now, as well as some historical context behind it. So Dr. Tait, take it away.
Thanks, Kevin. Thanks, Melissa. Thanks for having me on. Thanks for having me back. First, I'm going to preface this. I do not have a PhD in economics, but I do study it on the side. And interestingly enough, this is the first time that people have actually uttered the truism that the Federal Reserve has essentially created this inflation. 10 years ago, no one would have ever said that. When Ron Paul was talking about audit the Fed and all of these kind of things, people thought he was a kook and didn't know what was going on. But people who study monetary history always have always understood that if you have an unelected body of people who control how much money is in your system, it almost always ends in ruin, disaster, and excess debt. So what does that actually mean? And so, again, I'm going to try not to be super wonky and at least give examples. But what I want everyone who's listening to do is to get a pen and paper, write some things down so that you can go back and research for yourself. Don't just take my word for it. I'm going to give you a really simplified kind of overall macroeconomic vision. But I highly recommend, if you spend 30 days, 6 weeks just reading up on these topics, you will be more educated than 99% of people on kind of modern finance and the history of money. And so the first thing we want to talk about is kind of Keynesian economics versus Austrian economics. Now, we're not going to go deep dive into each one, but we for the most part run on a Keynesian model, which means that our central bank, the Federal Reserve, which is not federal and has no reserves. So understand, it is not a branch of the government. It is a private corporation owned by the largest banks in the country. So they are a private corporation. There's nominal oversight by our political system because we get to choose who the Fed chairman is, but the Federal Reserve Board of Governors are all elected by the private corporation. So these are private people with private stock. They pay roughly a 5 to 7% dividend to their shareholders every year. And you should probably research who owns the Federal Reserve, which banks own it. It's out there. You feel free to go out there and look. But their big mandate in the United States is, if demand, meaning if for some reason there's a unemployment or there's COVID or something happens, if there's a demand, what we call a shock in the economy, the Federal Reserve comes in and supplies that kind of demand in terms of make what's called easier monetary policy or accommodative monetary policy. That just means it's easier to get money in the system. Okay, it's just easier for loans to happen, easier for interest rates are taken down, and that pushes more money into the system. Okay, that's the Keynesian argument of the world, is that when demand falls, you step in as the central bank and fill that demand until the economy comes back. I'm not going to talk about good, bad, or indifferent. That's what we are. Go look up Keynesian economics. The other side of the street, for the most part, and there are other systems and schools of economics, is the Austrian school of economics. The Austrian school of economics, in my opinion, is the only school that has historically and consistently proven that what the Keynesians are doing would always end up happening, right? The famous Austrian guys out there are Peter Schiff and people like that, or any of the libertarians that you might hear out there that are true libertarians. Not Rand Paul, he's not a true libertarian, but if you really go to libertarian philosophy, they talk about sound money. And all that means is that when money is not created by unelected body of private corporation, money comes into existence because human beings need to trade for things. And though I may be a cobbler and make shoes, and you may be a farmer and have milk, you don't always need shoes and I don't always need milk. We needed an intermediary between the two, and that's how money was created. But money has always been backed by something of value. The value is not necessarily in that, okay, we say it's of value, but historically what the Austrians talk about is the gold standard, right? Or a gold exchange standard. Again, not going to go into the goodness, badness, or what have you, but I'm going to give you the rationale behind why it's important and why Bitcoin was created to mimic a type of gold standard. In that, gold was used because you can't just create gold out of thin air. Gold requires what we call GDP inputs or inputs. You must hire people, you must buy picks and shovels and axes, and you must pay labor to get it. So what gold ended up being was a proxy for the productive capacity of the economy that you were in at the time. So you can't just create out of thin air. Somebody has to work, things have to be created to create this thing of value. And then we tied our money to that thing of value. So in that particular point, it was gold, but gold is not specifically talismanic, right? It's got some great properties. It's useful in technology, but the whole point of it, whether it be gold or silver, is that there must be work involved, which shows you how good your economy is doing to increase the supply of new money in the system. Why is that important? Well, let's take an easy example. You have I'm going to do very simplified economies. Let's say you have an economy with 4 houses in it, 4 single family houses. That's your whole economy, right? And you have $100 in the economy. All things being equal, what is each house worth, right? 4 houses, $100, each house is worth $25, right? Because there's $100 in the economy. Well, if I'm an unelected person and I say, no, I'm going to put 200 in the economy now, what is each house, what can it now go for in terms of pricing, all things being equal? Well, now it's $50 for each house. But has the value of the house changed at all? Does it house more than 3 bedrooms and 2 baths? Does it create any more value besides the price went up because the amount of money in the system went up? That essentially is inflation in a nutshell. You have a larger increase in the amount of money in your system versus the amount of new goods and services that were created at the same time. Okay, that's it. It's no more complicated than that. People want to make it more complicated and demand push and all. It's not. When you have too much money chasing the same amount of assets, prices go up, and that's inflationary, right? And that's the difference between price and value. So let's stop there and see if there are any questions before we stop there, because I'm gonna walk down and make it even more in depth. But I want to make sure everybody has a clear understanding that more money, same assets, inflation.
I think you couldn't have it more succinct. I mean, that's the fewest words necessary to pretty much state what we need to hear, or a reminder of what's going on.
And Kevin, you're good on that?
I was going to say that's I think that's the best, simplest explanation. And I'm looking forward to sort of the behind the scenes thing, because there's already points of discrepancy of where. So I mean, just the things that are red flags for me right now. You have a private unelected board that are owned by financial services companies, these banking companies. We know by human nature, we ultimately have some desire of, we're selfish, and perceived self-interest is always a big thing. So if you have an institution of financial services that controls an institution that deals with monetary flow, that creates some concerns. And then the other part is the idea of production and money, like the value of exchange, like currency, or I should say value exchanges on the simplest level are always between the individual and somebody else. I got my milk, you got I forgot what you had, your shoes. I'm
a cobbler. I'm a shoe.
You got your shoes. And so that direct exchange, I got, 2 gallons of milk for 1 pair of shoes. Well, that sounds like a really good deal for me. And then we put money in there as sort of a proxy for that exchange. This will be very interesting, because I think there's much more to this topic of inflation beyond simple exchange and value as well. So
absolutely. So
let's go more.
Perfect segue. So the next thing I want to talk about is money versus currency. Okay. And because there technically is no money in the world today, because none of the currency units that are being passed around, the yen, the renminbi, the dollar, the euro, pick it, none of it is backed by anything but the full faith and credit of the governments under which are printing those monies. The beauty of the gold exchange standard back in the day was, if the United States became what we call a profligate nation, was spending more than they were producing, France would come in and say, you know what, cool, I don't want your dollars anymore. Take your dollars back. I want the gold that backed them. Give me that gold, right? Which is exactly what happened. And Nixon said, yeah, you know what, we're done. We're off the gold standard. That's literally what happened. Charles de Gaulle was like, hey, France needs its gold back. And Nixon took us off the standard because we would have been drained, because the United States was coming off of the Vietnam War, Johnson's Great Society, all of that extra spending, Social Security, all of that was coming to the fore, where we were spending more than we were producing. And the rest of the world said, forget that. We don't want your dollars. We want the gold. And so we came off the gold standard. We went through the stagflation of the 70s and 80s, which is what it was. That was essentially the second or third time the United States has defaulted on their obligations. People don't think that the US dollar has ever defaulted. We have defaulted before. And then we created what's called the petrodollar system, where we give the Saudis and OPEC dollars, and they give us oil, and they then take those dollars and put it back in the US treasuries, and that keeps our interest rates low. We're not going to talk about that. That's an aside. People can go do research on that, on the petrodollar system, and that's actually unraveling right now as we speak. With what's happening between Saudi and Biden, it's a whole thing that's going on right now. But take it off the table for what we're talking about today. So back to money versus currency. Money is backed by something. Currency is backed by whatever central bank is deciding to print that day. So everything that's going around in our society now, our US dollars, are currency units. Everything else are currency units, right? So they're not backed by anything of any value, but more importantly, they're not backed by anything that requires work to create more currency in the system. It's just a button that's being pressed. Treasury said we hit a debt ceiling. Treasury's like, we need more money. Federal Reserve's like, okay, send us over some treasuries. And people don't realize, which is the next point we want to get to, we're in a debt-based monetary system. What does that mean? Okay, back to our simplified economy. We have $1 in the economy. That's it, $1. Well, the dollar is created when the US Treasury says, I need $1, and then they sell a treasury note or bond, or however you want to call it, and to the Fed. And the Fed then puts the dollar into the system. But please understand that a note and a bond carries interest, okay? So we have $1 in the economy. It was created with interest, right? Because the US Treasury does not create our money. It used to, but it doesn't now. It creates our money with a debt attached to it. So if we have $1 and it's time to pay back that dollar after we've used it and done something with it, okay, we've paid it back. Where's the money to pay off the interest? There's only $1 in the economy. So where'd the money come from to pay the interest off? Doesn't, right? No one's ever asked the question, why does the Fed have to have a minimum 2% inflation rate? They must increase the monetary supply by at least 2% a year. Why? Because you must create a new dollar plus something to pay off the old dollar. So every year our monetary supply has to go up some. Well, what does that mean for you and I, right? People think inflation is benign, but inflation is actually the silent wealth killer. And so a 2% inflation rate after 10 years means 20% of your purchasing power is gone. In 50 years, 100% of your purchasing power is gone. So essentially you're being stolen from as a matter of policy essentially created by an unelected group of individuals that are bankers, that they're saying, we are taking 2% from you every year, no matter what. Right? Well, I did explain to you why that is, right? Because their debts can't get paid back unless new money comes in the system. So you just create a system that we just keep creating new money so that our old debts can keep getting paid off. That's a debt-based system. Our system does not have to be that way. From 1865 to essentially 1913-ish, the dollar strengthened. Average workers basically got a raise every year because the cost of living came down, not going up. People assume because we've been around since the Fed has been created in 1913 that everybody always talks about, well, the cost of living always goes up. That's actually not the case. And that has not always been the case historically. But because we allowed the central bank to be created in 1913, which was actually the third central bank in the United States, because the founding fathers had a massive fight about whether or not to create a central bank. Jefferson was like, no. And who's the other guy?
Hamilton.
The famous guy. Hamilton was like, yes, right? Yeah. And then eventually, once we extinguished the Revolutionary War debts, that bank went away. Then the bank was created again. Andrew Jackson hated bankers. He got rid of the second central bank. So our Federal Reserve is actually the third central bank of the United States. because the founding fathers, because they studied history, understood that if you create an unelected board to create your monetary system, you would ultimately end up with massive amounts of wealth concentration, and the average person would be bankrupted over time. All right. And so 300 years ago, the founding fathers knew this. If you go back, I do a presentation that I give, and I walked through this and I showed Jefferson's quotes about this, right? He literally predicted what's happening right now 300 years ago, because human history does not change. The first paper money was in China. They did the same exact thing we're in the middle of right now, 5,000 years ago, right? So if you understand monetary history, you understand that when we get to tipping points of massive amounts of debt, that things and revolutions tend to ultimately happen, right? And so that's ultimately where we are today, is that we're in a situation where just the US Federal Reserve has put an extra $8 trillion into the system. That doesn't count what the Bank of China is doing, what the Bank of Japan is doing, what the Central Bank of Europe is doing. Everybody was doing the same thing, where they were just putting massive amounts of debt into the system, because anytime you create new money, it's always new debt. And that's where we are right now, is that hangover is like, oh, the Fed's balance sheet is $9 trillion. In 2000, it was under 1 trillion. And people are just like, you know what? And then COVID came in, and then we had supply shocks on the consumer side. But please understand that this is a long-term cyclical inflationary process that is happening. And so when you get your stimulus checks, when you get all these kinds of things, that makes it worse. You can't fight inflation by giving out more money, because that just causes more inflation. And so that's the disconnect you're hearing in the national media. But politicians care about votes, so they don't care. So they're going to try to put money out there because they're going to want to make their constituents feel better. But ultimately, we have to swallow the bitter pill of draining this debt out of the system, and it's going to be painful. But if you've got a good job, just hunker down and try to buy things that are levered to inflation, right? That's kind of my philosophy has been. I've been talking about this stuff for over 10 years. You can go back and look on message boards and blogs where I talk about the Federal Reserve and where this ultimately is going to head, and why we've always bought the kind of assets that we bought. Now is just a time where people are like, oh, this is why you've been doing all this? I'm like, yep, this is why we've been doing all this, because we knew this was ultimately going to happen at some point in time, right? So, but that's where we are in a macro standpoint. Too much money, same amount of assets, inflation. And now the Fed has to jack up interest rates to drain the money out of the system to tamp it down. The problem is they're going to have to, people say, break something. Well, and I'm not going to go super wonky, but the bond market has been crushed, right? Because bond prices move inversely to interest rates. So as interest rates go up, if you own a bond, the value of your bond goes down. Now, if you hold that bond to maturity, you'll still get paid out what you were expected. But if you were ever trying to trade that bond, you're going to lose money. And so because people use US Treasuries as collateral, when interest rates go up, the value of the bond that you're holding goes down. You need to post more collateral if you're putting it up against some things. So the thing that has had the most issues has really been the bond market. Though people who are in 401ks and IRAs have felt 20 to 30% loss this year, there's been even more pain in the bond market. And the problem is the bond market is way bigger than the stock market, all right? And so this volatility is not going to go away anytime soon in the stock market, because until the Federal Reserve decides that they're going to not tighten either quite as fast, or are going to what they call pivot and say, okay, we're going to do basically a neutral policy. We're going to keep interest rates at this level. You're going to continue to see volatility in the stock market, I think, as my opinion.
Everything you're talking about on a consumer side, and it just seems like there's so many people that don't understand the long game, and some of these things, and how fear is playing into this. Any comment about just fear and of course humans throughout time have probably demonstrated the same kind of behavior, but any comments
Absolutely.
on that? Yeah. So
it all depends on where you sit financially, right? And because I'm not a super consumer, but I buy assets, right? So I always think of things in monetary standpoints in terms of what do I own, and do the things that I own produce for me when I'm not out there working, right? So if you've got a good job and everything is okay, all of the wealthy people that I partner with and hang out with, we are sitting on the sidelines salivating and buying everything we can buy. Because anytime there's fear, uncertainty, and doubt, people make bad decisions on good assets. And so, I'm not a big stock market person. Even with a 30% drop, the stock market needs to drop another 20 to 30% just to be back at fair value, because so much of what the Fed printed of that 8 trillion found its way into the publicly traded markets. They're still overvalued, even though we've had this massive drop. And so for me, again, it's about buying the correct assets at the correct valuations, right? Do you know what you're paying for in terms of what you're buying? So right now is actually a very good time to buy the correct kind of assets, those that are levered to inflation. I like tech stuff, because right now, who's getting laid off in the economy? Tech workers. Who needs tech workers? The startups, because they couldn't afford them before, because Google was hiring everybody at $250,000, coming straight out of college. But now these engineers and people are getting laid off. Where are they going to go next? They're going to fall down to the startup companies who need those workers, because they're still solving problems in our economy. Whole swaths of our economy still need to be digitized. There are great companies that couldn't hire. Now they're going to be able to hire, right? And so I always like recessions to build businesses and buy assets, because that's when everybody's running, everybody's scared, but that's when prices start to soften, they start to come down, people start getting desperate. And so you can get good assets, you can get good workers. And if you're in a good business that you should expand, now is the time to expand, when people are being laid off and you can get good talent at great rates. So this is not a time to be fearful at all. I mean, if you're overweighted to the publicly traded markets, yes, you probably need to do something around that, right? Because we're probably in for a choppy road for a little bit while the Fed has to drain all of this liquidity out of the marketplace. But beyond that, and making sure that you're fully diversified and not just public assets, but also private assets, if you've already done that, now it's just a time to go very selectively shopping for good assets and good businesses, or to expand your own business at this time, because there's going to be talent on the street that gets laid off from other places.
Yeah. I think it's funny how a lot of people don't even think, and I don't really necessarily think in the terms of draining liquidity from the Federal Reserve. Like most average person is not going to think that or say that. Like that seems, I think, foreign to them.
Yep,
I would think.
But they do know that essentially they were able to get their house at a 3% interest rate, right? Where in history have you ever had a 3%? I mean, the historical 5,000-year average of interest rates is 7%. So you knew something was going on when you're able to get a sub 2% mortgage, or a sub 4% mortgage, right? Yeah. So everybody has an inkling, right? Everybody loves it when the party's going, right? But when it's time for the hangover, when it's time to actually exercise and drink your water, everybody's like, oh, what's happening? What's really happening, right? We were the beneficiary of bad policy on the way up. You now have to position yourself on the hangover of the undoing of that bad policy, because when people talk about the Fed balance sheet, all that is just think of new money, liquidity in the market, more money, less assets, prices are going up, interest rates are going down, right? Yeah. Now the Fed, and that created inflation. Now the Fed has to do the exact opposite. We must pull the liquidity out, which means interest rates have to go up. So there's going to be some pain in that process. But if you're buying things that are levered to inflation, you don't have to take the financial hit in your personal net worth in that process. Yeah. You just have to know the right stuff to buy at that point in time.
Gotcha.
Now that's a little bit more complicated, because it's not the public market stuff. That's where it gets more complicated.
Kevin?
So much to discuss there. So much. I mean, I guess one of the first lenses is kind of take off your humanity lens and just look at this from a very complete objective. I think when it comes to finances, it is always best to look objectively rather than empathetically. And I say that because there's a bunch of points here where someone can start screaming and yelling and saying how unfair it is. And on a humanity level, it totally is. But when you're looking at things objectively, and hopefully the listeners here are looking at things that objectively, it's like, well, what can I do to actually preserve capital, preserve my wealth, and or to make sure that my family stays safe? Now, we're not saying to go out and rampage the environment in the world and to be cruel to people. What we're really talking about here is what do you need to do? Because this stuff is happening behind the scenes. Like, it is always interesting to me. There's the story that is being told, and then there's the story behind the story, which is, whatever they're doing in the halls of quote unquote power here. Like, When I check at news, I was like, what are the headlines? And the next thing I do is what is the business headlines to see how those things line up. So I just wanted to put that out because there's points here where I'm like, just like, oh my God, this is just killing me. Because when you're talking about like the how the Federal Reserve, or the third time that we've done this in 1913, shortly after 1913, we had the Gilded Age. So we had this massive acceleration of concentrated wealth in the hands of the few, which then terminated into the stock market plummet of 1929. It seemed relatively quickly. Yep. We come off and start the gold standard and what, the late 60s.
So,
and then
we did Bretton Woods after World War II. And so that's where the rest of the world said, hey, United States, you're the biggest producer on the planet. You back to gold, we will then peg all of our currencies to you. And then we rebuilt Europe, and that went from that standpoint. But we then became profligate with it. We started spending, and that's what rich nations do. You overspend your productive capacity.
And didn't we end up taking a bunch of gold from the Brits as part of that whole process? I
know we held their gold for World War II, but because of our special relationship with Britain, we probably gave that back.
Okay.
But there's some other gold we have not necessarily given back, but I won't go there. You can do your conspiracy theory tinfoil digging off after that.
Well, there are conspiracy theories are just like crazy, and then there's conspiracy theories is like, well, you start looking around who benefits for what. Because I mean, and then the other kind of, I'm looking at this from like this macroeconomic line of, we're in a very privileged position here. We're physicians. We have good incomes. We're relatively stable. We're fairly aware of what's happening in the markets. And again, I know you don't like the stock market. I have most of our assets in there, and it doesn't stress me out because the last time it dropped, we bought a bunch of it, and so it happens and it goes up again. And that's sort of like my idea. Like that's the hedge on the bankers, because the bankers aren't going to lose money, and the stock market is where the bankers are sort of.
Well, no, remember, they're brokers. They get paid up or down, so they don't care.
Yeah.
And they take a percentage of your money, so it doesn't matter to them if it's going up or down. I would just say, be mindful. So for those of you who have more than 80% of your net worth in the publicly traded markets, what I would highly recommend is you learn how to do a discounted cash flow analysis so that you can actually understand price to earning ratios and understand how companies are actually valued based upon what they produce. Once you understand that and can understand the difference between price and value, then you're making a much more informed decision about where to place your money, as opposed to passively placing it. Because I can make the argument, if we're talking about mean regression, that we've had 20 plus years of overproduction in the stock market. So we're going to have 20 plus years of underperformance to get back to the mean. And so the question is, are you going to be trying to retire during that 20 years of underperformance, right? Yeah. Or will the Federal Reserve just continue to print money to prop up the stock market? Well, they really can't do that because we hit inflation. So they're telling you inflation is more important than your assets. So we're going to bring your assets down while we fix this inflation, right? And so I just would be mindful of that. Again, I don't give people advice. I can only tell people what I do. I can't tell other people what to do. All I can give them is frameworks around how to potentially think about owning assets. And for me, I have to always understand the value of the asset, not the price, when I'm buying it.
And that's the key, I think, is for people to hear assets. We're talking assets and what produces and what doesn't.
Yep.
And this kind of just, again, like reminds me of is like, if you look at post-World War II, and we have this accelerating middle class, and then there were still fairly, really wealthy people, but the concentration of wealth was much less. And then we look at what's happened since the 80s, where it's the exact opposite has occurred, where we're seeing this massive wealth concentrated at the top, and then we're seeing pretty much the middle class kind of getting annihilated at the bottom here.
Correct.
And from a humanity standpoint, it's like, well, because the pain is going to be felt universally, but the people who are going to really hurt are the middle class who don't understand this at this point.
No, the upper class never, the concentrated wealth in the upper class, they never get hurt. They don't get hurt because they understand, because they play both sides, right? Ultimately, the argument is always, you don't try to beat the Fed, be the Fed. How does the Fed make money? They create money out of thin air. They borrow money into existence from nothing, and then they make interest off of it. Pretty good game, right? Pretty good racket you got there, right? So the question is, how do you, and the beauty of doing that is this, because you know that they're going to create inflation, what you do is you borrow future dollars into today, and you pay it back with devalued dollars over time. It's the reason why the wealthy are so concentrated in real estate, because all we're doing is we're hedging the dollar. We're pulling the dollar into the future to buy an asset today. The asset price goes up. The cash flow goes up. I pay off the debt with dollars that are devalued that I didn't want anyway. I'm left with the asset when the dollars are gone and the debt is gone. But the price is going up, the value is going up, the cash flow is going up in that process, right? Again, real estate is not talismanic, but it's the one hedge where you can actually be the Federal Reserve. It's the thing that is a proxy for what they do in the economy. It's the reason why they didn't bail out homeowners. They bailed out the banks, right? All they did was bail out their own constituency group. You want to be in the group that they're going to bail out. That's all.
And so I want to dive into that more, because some people may not know what you're talking about when we're talking about you're talking about really is like leverage and debt.
Correct.
And so what I want you to do is, because there's we got like there's fundamental rules that are like foundational rules, which make sense at like level 1. And level 1 would be, don't spend more than you earn, et cetera, et cetera. Debt is bad, like on a basic foundational level. And if you're thinking really simplistically, that makes sense. But if you're trying to make the next step, what you have to do is figure out what is good debt and what is bad debt. So could you kind of talk about that a little bit more, the difference between good debt and bad debt, and how that works for the creation of
it's very simple. Bad debt you pay for, good debt pays you. What do I mean by that? So we don't even call it good debt, we just call it leverage, right? So debt you pay, leverage pays you, right? And so credit cards are bad debt unless you took the money off the credit card and bought something that generates a higher return than you have to pay on the credit card. Now, if you don't know how to do that, you don't do that, right? And again, most of us can't make 24% a year on our money, so we don't borrow against credit cards, right? But we do go to banks and get loans at 5 and 6 and 7% because we can easily make 10, 12, 15% a year with almost no sweat, right? And so the question is ultimately, and let's take it back to a more fundamental level. Each of us gives up 8 to 12 hours of our life a day in the pursuit of capital. Let's just start there. You add that up over your lifetime, that is going to be 30 to 40% of the time you spent in your life. You are going to get this representation of your labor, soul, spirit is here, okay? And then you're going to do something with that, right? You're going to buy a house, you'll raise some kids, you'll have a car, you'll save, you might have a second vacation house, you'll have some leisure with it, right? But ultimately, those are all consumptive processes, meaning you spent the time, now it's gone, it is burned, right? So the question you have to ask yourself is, what am I going to do with this representation of my hard-earned, literally, life, soul, spirit? What do I want that to do for me? It's really no more fundamental or basic than that. I've sacrificed a portion of my life that I will never get back. How does that then turn around and benefit me, right? And so there are many ways you can think about this, right? Most of the ways back to level 1 is put in a 401k, put in an IRA. When you're 59 and a half, if you make it that far, you can get it then, because we're gonna give you a little bit of tax breaks. You can get it then, but you're gonna work your behind off from wherever you are now to that particular point in time, right? I just took a different philosophy. I was like, I need this thing that I worked for to benefit me today as well as in the future, because I don't want to work quite as hard today. So I need to put in some things that will pay me today so I don't have to work outside the house quite as hard, and so that it begins to compound and snowball, right? That's a different philosophical thought process. And that's more like level 3, 4, or 5, right? But the way you do that in an accelerated fashion is you're using that good debt to buy assets that pay you. It pays the debt off. You get the cash flow and the assets that's left over, right? It's no more complicated than that. I used to tell a story about kind of the nativity scene, right? The nativity scene was a real estate deal. There were not enough hotel rooms in Bethlehem, so they went to a manger, right? Real estate is everywhere. I don't care what good book you go to. I don't care whatever. Always people doing something with real estate, rental, whatever the case may be. It's a basic human need. It is low on Maslow's hierarchy, right? And so before the tech age, most of the Forbes billionaires were real estate people. And once you go below the tech guys, it's all still real estate folks. And so that is the basis of most of our financial system. Capitalism does not exist without the leverage and mortgaging of real property, right? It's not talismanic. It is the basis of what we do. We are all living in a house. We are all working in buildings. We all drive on freeways. We all, right? It is a baseline of what we do. So I always just argued, own a bunch of that stuff and let it pay you and you're good, right? You don't have to worry about the Fed. You don't have to worry about all these other, you don't have to worry about inflation, because when inflation goes up, you just raise your rents, right? It's the easiest way to not have to think about the macroeconomic environment and worry about all this volatility and worry about all this, the up, down, left, right, or center. It's the lazy man's way or woman's way to get wealthy and not have to think about it. Right? It takes some upfront thinking about it, but long term, it really doesn't. And so that's for me has always been the reason why I would always base my wealth there. And then we did other things after that from that standpoint. So, you know,
well, I want to bring that back is because Dr. Tait has been on our podcast many times, and there's a reason we have him back many times on this podcast. So if you go back to those earlier episodes and we talked specifically about some of the life choices he made as a physician, where he worked less, some people to earn less of his physician income in order to have the time to kind of plant the seeds in these asset producing, or I should say, well,
income producing
assets. That's the word I was looking for. Income producing assets. Go back and listen to those, because I think that's, again, awareness is like a key point on this podcast. It always will come up in every single episode that we have, is the more that you are aware of how things are and how things flow, the better off you will be. And if you think about currency as a form, like I can't remember where I read this. This is a while back, but you kind of visualize it as a piece of your life. If you are working at X and this is the dollar amount that you're getting, and then you have to take that and spread it out over 24 hours. Every dollar that you have is basically a piece of your life. And so how much is that worth? So people, like, oh, I'm going to get my Starbucks coffee for $5. Well, there's a point in your life where that's a significant chunks of your soul, right? And so if I'm going to take a little bit less now, and I'm going to instead of think about, okay, I'm just going to spend my life chunks, I can take that, maybe actually eat a little bit less in this moment in time and plant that seed into an asset that's going to grow and provide me more later on. That's a way to think that I know I wasn't taught growing up. I mean,
listen, I got lucky in that Robert Kiyosaki wrote Rich Dad, Poor Dad my first year of medical school. My college roommate called me and said, read this book. That's the only reason I know this stuff. And that's the reason why I go out and preach this to people as much as possible, especially physicians, is because really nobody's taught that, but we absolutely aren't taught that, because we are sequestered away for 12 plus years or longer. We have a very unnatural production process to make us, right? Lawyers, because the world is created by lawyers, them learning the law gives them a leg up in life, right? Business people, you usually have to work a couple years out of college before you can go to business school. We're the only ones that go almost straight through. And even if we don't, we're trying to do some medically related thing to burnish our resume to get into medical school. And so we're cloistered away in a portion of the economy that, while it takes up a lot of gross domestic product, it's not a productive thing. It is a reactive thing to help people when they are sick. But we don't produce stuff for the economy. We try to help people and keep them still producing. So the things that we see are really not applicable to real life in terms of us living outside of the bubble of medicine. And so we don't have an easy pathway mentorship molding to help us think through, okay, cool, you're now a physician. What does that mean, not just for what your parents and your family and your society and your religion or all these other things think of what you should be and what you should do, but what does that mean for you? What does that mean for your life, right? I know we're all taught we're supposed to give up everything for our patients. Cool, that works, right? But
till you die,
one of us are committing suicide once a day, right?
Yeah,
we lose one of us every day to suicide, right? So clearly that model isn't really working as much anymore, right? But no one sits and says, okay, the course in medical school is who are you and why are you here, right? No one has that. No medical school has that course. And so there isn't a mentorship pathway through how to make sense of what we may owe society, what society may owe us, who we are outside of the healthcare system arena with the understanding, because we have no real autonomy in healthcare, right? So super well accomplished, but we have no personal autonomy in the thing that doesn't run without us. Creates massive amounts of cognitive dissonance, right? And so that whole thing and our whole process through this is very stunted, I would like to say. And so that's why I go on and try to get people, while I love Kiyosaki and all that, I learned more through the personal development arc inside of this to understand who I was and what I wanted, which then informed the economic choices I was going to make to give me the freedom to be the person that I wanted to be. You're not going to be the person you want to be if your economics are all messed up. You've got to figure out how to get your breathing room before you can become and understand who you are in many ways.
Yeah.
You could shout that from the top of the head, though. I mean, literally, who I was and what I wanted. This should be the prime question that everybody asks. Like, who am I and what do I want? And it sounds kind of, it may sound kind of facile in a lot of ways, but there's such a depth to that, because if you understand who you are, and a lot of times I think this is because this has been profoundly difficult for me. What is it that you actually want? Like truly want? If you understand those two things, those are 2 points of leverage to really guide that path in a way that is conscious, aware, and intentional, rather than being whipped back and forth. And like you were saying, we go to medical school and you're just trying to survive and get through this stuff. And then on the other side, you're being, well, now you need to buy the doctor car or the doctor house, or there's a certain lifestyle that will kill you. Because the other part, as we're talking here, I'm thinking is we are coming into this economic environment that is full of uncertainty. Uncertainty can be super scary, but also produces opportunity. And the advantage that we have in the healthcare related fields is stability. Now, we may hate that, we complain about the hospitals and all this other stuff here, but we can generate income relatively easily as compared to most of society. So for physicians, this is it. As long as you're not overspending and you're not wallowing in bad debt, you frittered away your life, your life chunks. There's a lot of opportunity here, right? What do you, with the people that you deal with, how many of them are physicians, and or how many of them are really kind of looking at this as, hey, things are really uncertain, but man, there's some opportunities here because we know who we are, what we want, and we understand how to apply good thinking principles about money.
Yeah, I would say probably 80% of my investors are physicians. That's over 300 some odd. And because they come into contact with me, I'm putting these principles out as much as humanly possible. And, anybody who signs up with me, they get an hour with me where I just walk them through, hey, what are you trying to accomplish? Everybody will tell you, what do I ask? What are you trying to accomplish financially? Like this is not a pitch fest for me. Yes, we do deals. It may or may not work for you. Doesn't matter. Let's walk through what you're trying to accomplish financially and why. And then I'm going to take that why 5 levels deep.
Yeah.
Why do you want to do this? Ask yourself why 5 times. Then you'll get to your actual emotional core. And then you go back from there and then set your life up. But Melissa, you were going to say something earlier from my comment. I want to make sure we get that in. What were you going to say?
Well, there was just so much, the whole personal development, the change physician. There is a huge part of physicians that run the treadmill. They run the treadmill of expectations, the treadmill of service to others, and never servicing themselves. And it's this complete commitment to whatever this path that's just basically structured for them. And they don't even know how to structure their lives for themselves. And there's this huge awakening I'm finding, not just in myself. And I think COVID has helped kind of burst that open in some people. Absolutely. Where they're a lot of people are going to locums, even nurses, I don't think it's just the money. I don't even think they realize it's the autonomy and this sense of the time to step back and realize, whoa, this is going so fast. I don't even really know who I am. I don't know what I want. I need something different. I have friends I know currently that are I get excited when I think about something else, the freedom to be myself and be creative and work from within instead of being pounded from the outside. So I just wanted to say that I'm definitely doing a trailer on that. There is so much we need to hear from that. And I love that. And I get very empowered. I think a lot of physicians just need to hear someone that's able to put that into words.
So let me give you all a secret, right? I give little nuggets of secrets out every couple of years about kind of the background of stuff, right? The big secret I gave people out last year was we just invest on the first two levels of Maslow's hierarchy. It's no more complicated than that, right? I don't advertise that, but if you look at it, what we do, that's essentially where we sit, right? Just stay low on Maslow's. That's my kind of rule in life. The second thing is I literally just created Vernonville just for that reason for doctors. I was like, if I could get physicians to work 1/4 to 1/3 less, but not take a financial hit, everybody's happier. Everybody's happier. Most people won't want to leave. They just, hey, I can cut down 1/4 of my time, 1/3 of my time. I would stay in doing this and I'm not taking a financial hit. Cool. So I have investors, I tell them all the time, what do you make a day, right? All we're trying to do is replace 1 day a week from a passive income standpoint. Your life will be infinitely better. Everybody's always trying to worry about replacing their full income. Nah, that's a monumental task. But replacing 1/4 of your income, 1/3 of your income, that can be done in 3 to 5 years if you're diligent about it, right? And I don't know if you all have experienced it, but once I got to that point, I was like, oh, like I don't want to leave medicine. I still practice because I like being a doctor, right? I could have long been gone, right? Long gone, right? But most of us who do this, we do it because we love it, but we feel trapped by it. And so I tell people all the time quietly, like, listen, if I could reduce your clinical hours by 1/4 to 1/3, and you did not take a financial hit in that process, how would you feel? And everybody's like, oh, there's very few people like, I need to leave medicine completely. Most just need that little space to breathe, do the creative thing that they gave up, the hobby that they gave up before they got into medicine, that thing that made them feel whole that they had to then sacrifice to get into this. And now there might be a mom or a dad, and they've got all these other life things that have come on to them. If you can give them that 1/4 sliver time back that's just theirs, oh, everybody's life would be so much better. Morale would be better. Champ scores would be better. Patient satisfaction scores are better. Like all of that gets better, right? That's all we're trying to do. That's literally all we're trying to do here, right? It's not any more complicated than that. And I just like, well, why don't I just build a business around doing this? Because it's a thing I wanted. I know other docs want it. So why don't we just build a business that can help people do that? That's literally the secret of that's all this is.
Yeah. Well, my question to you is for people that feel like they have the intelligence level to eventually understand this stuff, but where would you say for people other than Vernonville, or in addition to Vernonville?
Where take me out of it? I'll just, we can just give like starting points, right?
Yeah, like how do they educate themselves?
The easiest. So I'll give you the non-helpful to me answer, and then just read Kiyosaki's stuff. I don't care what you feel about him philosophically. I don't care what you feel about him politically. That man is responsible for more millionaires than probably anybody else on this planet, just in terms of the things that he's taught. But the beauty of it is he takes you behind the scenes of what's actually, so what Kevin, you were talking about, the story behind the story, he gives you the story behind the story. He gives you the understanding of how money actually works in our current society and our current monetary system, right? If our system changes, then the philosophies will change, but this system isn't changing because it makes the people who designed it very wealthy. They're not going to give it up, right? And so the easiest is just read Rich Dad, Poor Dad, the cash flow quadrant, which is the most important one because it really teaches you accounting, right? So you can really understand what your personal balance sheet actually looks like, right? Rich Dad's Guide to Investments, which shows you how you do private deals, right? Whether it's buying a business, whatever the case may be, and just in terms of how you can gear it, how you can lever it, all those kinds of things. And then tax-free wealth, same issue. How do you set yourself up in such a way that you can minimize your taxes legally, right? The whole series will give you a very good overall general understanding of how money works and how the wealthy pay no taxes in our society, right? Now they don't pay personal income tax. They pay a ton of property taxes. They pay a ton of payroll taxes. They pay a ton of like that joke that, oh, Bezos doesn't pay any taxes. Yeah, Amazon pays a crap ton of payroll taxes, property taxes. Like they pay a lot of taxes, right? He may not personally pay taxes, but the business pays a ton of taxes, and that money would have gone to him had the business not paid taxes. So I kind of get a little funky around people not understanding the tax code when they talk about, well, there are loopholes and this, that, and the other. Yes, anybody can take advantage of them. You just have to set yourself up in a certain kind of way, right? The argument is always capitalism only works for those who participate. If you are only a consumer in capitalism, you are getting the short end of the stick. You must produce something. Now, that may be you just investing in an early stage company. That may be you just being in the stock market. That may be whatever the case may be, but you have to participate. Or the system, if you're only a consumer, the system will run you over. So remember I was talking about, what does your portfolio produce for others? That is the basis of capitalism. What does my money do for other people? And how do I get a percentage back that comes back to me in that process? That is capitalism. People want to call it a bunch of other things. That's ultimately what it is. It's why McDonald's used to put up how many they served over time, right? Because that is a proxy of how much money they're making, is service to other people, right? But again, let's not get political at this point from that standpoint. So the early thing to do is rich dad stuff. Now, I created a whole essentially nonprofit website called thephysiciansroad.com. There's tons of reading on there. I have my own podcast stuff. I don't do it very often, but I have a bunch of stuff that what I created was a kind of a life balance wheel for physicians on that website for free. It just lives there. I pay for it. It just lives there, right? It's not linked to our investment firm in any way. It's not any of those kinds of things, right? It's just free educational content on finances, on real estate investing, on early stage investing, and marriage, and negotiations, right? All of that kind of stuff. I just put it up there for free as a give back to the profession, because I didn't have a site like that when I was coming up. I could just go through it and like, oh, I didn't know anything about any of this stuff. And then you can do further reading over time for the things in the areas that you want, right? And so I literally designed a site to basically be a mentorship platform, because I don't want to do coaching and I don't want to do that kind of stuff. So I said, here, what I have in my brain, it can live here. You can go get it without me, and then you can reach out to me if you want something, right? And so that's kind of the two things. If I were building my own mentorship that I would have wanted, I built that website for that.
I'm just going to pile on there too. And I get confused because I know there's Vernonville and I know there's Urban Capital Network. And so I get confused on that stuff, and I get emails from both. But I'm just going to, this is a pitch I'm going to put out there that Eric we didn't do him on this for this. We obviously, there's no affiliate relationships here, but if you sign up for his email list and you haven't written for a while, because I've been watching for it, you get some of the most insightful financial.
Something went out last week.
But that was a short one. That wasn't very long.
Yeah.
You get some really long ones like last year that were like, oh my God, I'm going to just save this and bookmark this thing.
Yeah. Because we're doing a bunch of deals right now. That's why, right? When I get busy on deals, the other stuff has to fall by the wayside, because we're really busy on deals right now. So,
and I want to sign up for the email list simply for this, because no matter whether you invest in the deals or not, your presentations are fantastic. They're so educational, and you may I don't know what's going on, but you break things down. The ones I've really enjoyed are a lot of your startups when you're coming in, because you were investing in these early stage startups, and it was just really cool. And to see and to kind of hear the dynamics in the background. And if you're just watching them passively, you start seeing some insights. Well, why are they doing this deal? What's the common theme between this deal and this deal? And you start seeing these trends. And so I highly recommend that. And Eric didn't know I was going to say that, but
no, I appreciate that. And I purposely do that. I tell people, even if you're not going to invest with us, I don't care. I do care, but ultimately in the end, you're going to do what's best for you. Right. But I purposely make the investor presentations educational, because we are not taught this stuff, right? We are not taught any of these things, whether half the stuff I was even taught in business school, right? So all I'm trying to do is take the stuff that I learned and pass it back down to other folks, so more of us can participate in what has historically been a very closed loop system that most people cannot get access to.
Yeah, I love it. I know we could go on forever about all of this stuff, Kevin. Did you have any specific questions, Kevin, that you want to target? Because I have a feeling we probably are going to ask him to come on again one day.
Well, of course. Of course. I think every time we say it, we got to have Eric back. I just like talking to you, Eric. I mean, I just really enjoy it. I wish you lived closer to me, because I'd love to just, sit down and have a drink somewhere. So you have to come up to closest city to us is Portland. So maybe we should have to do something in Portland or I have to. So I guess you all need Texas.
So you all need to do a conference, and I can come speak at the conference.
There you go. That's a great idea.
I was just thinking about that yesterday, actually.
There you go.
But I wanted to do a kind of quick summarize here, and then Eric can kind of put in your summarization of what I'm saying, because we started this off on kind of what the current economic state is, sort of the historical background for that, and then discussed it kind of a high level detail of opportunities that there are. I do want to the listenership here, predominantly physicians, physician allies, et cetera. While we kind of gear things toward physicians, this is applicable to you as well in many different ways. For physicians, again, this is super exciting time for you, as long as you're making sure that understand the difference between leverage and bad debt. Minimize your bad debt. I can't say that often enough. And if you just can kind of give a real quick summary, Eric, on where you think, if you were a physician now and you were just sort of entering with the knowledge that you have, what are like the next two or three things that you would do over the next year?
Learn how to read an income statement, balance sheet, and cash flow statement. You can do that at Khan Academy online. Understand the difference between price and value. You can do your research on figuring that out, but easy way Buffett looks at it is price is what you pay, value is what you get. Okay, that's an easy way to think about it from that standpoint. And then really think about what you want your life to look like in 10 years from now, in terms of whether or not you have, if you're a new starting out physician, do you have a spouse or not already? How many kids do you want to have? Where do you want to live? And then do you want your labor to be the thing that has to pay for that? Or do you want to do some things financially where you're working at a steady pace, but you're generating income from money you've already made to help pay for your lifestyle, right? And so really think about kind of what you want your life to look like. Who are you as a whole person? And then you work yourself backwards, because people have a good tendency to plan out a year, but don't think about 10 years from now. Where do I want to be actually living? What size house does that look like? What is that going to cost? All of those kinds of things. But am I going to give up my life to achieve those material things? Or can I have the material things that I want because I've done some financial things on the front end to make that happen without me having to give up more of my life and spirit and time?
Can you remind us of the website for learning how to read income statement and all of that?
Oh, Khan
Khan
Academy. KHAN Academy. You can just pull it up on YouTube. It's pretty easy.
Okay.
And then the next step would be a discounted cash flow analysis. Once you understand how to read a balance sheet, then you can do a discounted cash flow analysis, which then allows you to value publicly traded assets from that standpoint. Because most of the people listening here are going to be in 401ks, IRA, stocks, those kind of things. But the problem is most people are buying them. They have no idea what they're actually paying for them in terms of the value, right? Like, are you overpaying for it or are you underpaying for it, right? Would you pay $1 million extra for a house that's worth $500,000? No, you wouldn't. But people are doing that every day in the stock market when their money just kind of passively goes into a 401k. Often not over the past 10 years, you've been basically overpaying from a value standpoint with the hope that just keeps going up. And the fuel that was making it go up, the Federal Reserve printing and adding that money into the economy, they're telling you we are taking it out because we are raising interest rates, and that takes that money and liquidity out of the economy. So the question you have to ask yourself is, what's the fuel to make the prices continue to go up when that is going to be drained out?
Got it. All right, Kevin, you want me to take us out?
Take us out.
Well, Eric, thank you so much. You are always amazing to talk to about this and get our minds back on track. And one of the biggest things is obviously some of the beliefs out there may not be really the truth of what's going on. And so thank you for, just explaining some of that. And we look forward to getting you back on and talking about some more topics, I'm sure. So
I appreciate it. Thank you.
Yeah. Well, for those of you listening out there, I'm Melissa Cady, the Challenge Doctor, with my co-host, Dr. Kevin Cuccaro, and we look forward to seeing you on the next episode, and make sure to join us at thechangephysician.com and be part of our community. Take care.
Stay well, folks.
Bye-bye.